Hello again. I'm hopeful that this particular chapter will be a little bit less in terms of time. I know 30 minutes is a lot, but my goal with the videos will be just to give you some highlights of things that I think are important that you need to remember, give you an idea of the things that you need to highlight in your reading, and maybe go over once or twice so you can understand the concepts and things that you can possibly look forward to when you're going through your homework assignments. It's quite important to note that this chapter is a very, very natural extension to chapter 9 because we're talking about long-term items on our balance sheet. In this case, on the opposite side of it, which would be the liabilities, claims to the assets of the organization. So we will talk about those. We're going to talk about current liabilities as well, which you're probably very familiar with because of the project that you've been working on the past few weeks. But let's go over them anyway. Obviously, when an organization is receives funding from a bank, it's a loan. It's some type of credit being offered to them, so they pay for it later, and they also pay for that benefit for getting that money, and that's in terms of interest. So you have an obligation to pay something. If you have an obligation to pay it, and it is less 1 year or less, it's going to be a short term or a current liability. Obviously, that if it extends beyond a year, it's going to be long term. And we all have gone through these because you've seen it within your project as one of the entries for a note payable for 2 years. That's clearly a long-term obligation. The most important thing is it's an obligation. You owe someone something, some form of asset. The asset is due back in 6 months, 1 year, 2 years, long-term or short-term, but it's nevertheless an obligation. Accounts payable, we know about those as well because we have been recording a ton of entries where you buy something from a vendor and you pay back within 45 days. Accounts payable are operational type of things. Accruals are the same thing. And we've also been recording accruals, as you know, in your project. And these are accrual liabilities, which relates to wages for the most part. And you'll also be recording accrual for interest that you'll have to pay for any loans. So we are very familiar with these two. Obviously, these are going to be less than a year, so they are current liabilities. They have a current claim to the organization's assets, and that's very, very important to note. That's why it's an obligation. You have a claim against something. In this case, your assets. A note payable most often is something that you have a written document, and again, if it's short term, it's going to be 1 year or less. That's the difference. Notes generally have interest rates are tied to them, which means they're not like accounts payable where you pay in 30 days and that's it. In some cases, you might get a discount if you pay it quicker, then you're obligated to pay it. Note payables are generally characteristic of it being in writing and also having to pay with interest. And here are some transactions. Again, if you're talking about boating companies purchases some items on an account with $10,000 and you pay it in 30 days, but you get a discount if you pay it early. So this is generally the type of entries that you're recording, but you have recorded these entries before. This is not anything new. Very, very standard entries, and you've seen them before. We're just giving them more of a highlighted overview simply because they are very, very significant in some cases to an organization. So if you borrow from a bank and they issue a note, obviously it's going to be a writing. Obviously it's going to be interest tied to that. Sometimes notes are discounted, and they are discounted only to show that the interest rate or the interest that you're going to be paying back is embedded inside of the note itself, and it's not a separate amount. For example, I have a $10,000 note payable. I pay it back along with interest. A note that's discounted may say this is the note amount of $10,000, but in reality, you only get $7,000. The difference between what you get and what the note is in total, that difference is called a discount. Well, another word for discount is going to be the interest. And that's simply simply a new way of looking at things, but it truly is. You're not getting a note for free. You are going to pay for it. It's just a question of the interest being embedded into it because it is a non-interest bearing type of note, and it has no interest rate in it. Basically, a lot of leases are handled that way. When we talked about lease assets in the other chapter, but a lot of times leases, capital leases, are handled in that way. They don't have an interest rate. It's embedded into the cost that you pay back, which you have to back into or figure out what it is. And that's just another way of understanding that. So so what happens generally in many cases, if you have a long-term debt, and I'm talking about a 30-year debt, and that debt requires you to pay principal, a portion of the principal every year. Well, the thing of the matter is that long-term debt has two pieces to it. Part of it, of that debt, is short-term, and part of it is long-term. And this is what we mean by a current portion of a long-term debt. If the portion of that debt is due within 1 year, then you have $1,000 of a debt that you have to pay in a year, and the other $99,000 is going to be due in the remaining part or beyond 1 year. And that's generally what happens. Sometimes there are notes that you have to pay the principal back, but instead of paying the principal back at the end of the term, you pay a portion of the principal, depending on the loan agreement, over a period of time, over a year. You pay 1 year, you pay $10,000 of that debt and that principal in the first year, and then you pay the rest of it 2 years after the fact. You will see one debt, but two pieces to it. One part is current portion, which is within a year, and the other part is past a year. And that's all it's saying. Installment notes are, again, the same type of thing. There might be a long-term portion of that installment note and a short-term portion of that installment note, and the trigger is the same. If it's due in a year, it's current. If it's due after a year, it's non-current. And that's really all you need to know. Current on liabilities like payroll, obviously when you and I get paid from our employers, we don't always get paid on the day that we finish completing our service, our work. Sometimes there is a lag, a week, maybe two, depending on the organization, between the time we've actually done the work to the time we are obligated to receive our paychecks. So for organizations, they have to record that obligation to us, that money that they are going to pay us for the work that we perform for them. That's going to be a payroll obligation, in which case it is most certainly, in my case, and I believe in yours as well, a current liability, because they're not going to pay me a year from now. They're going to pay me within 2 weeks of that amount. So it is a very liquid liability that the organization has to pay back to the employees. But again, it's all about not only the payroll wages that have to be paid, but also the taxes associated with the payroll. That means FUTA withholding is a liability. FICA withholding is a liability, in which you will have to accumulate that liability and ultimately pay the third party, in this case some governmental entity. Again, it's a payroll liability, whether it be to employees or to the government. And this is just breaking out the difference between salary and wages and all of that, and that's perfectly fine because you already know this. The major thing I think in this case is wages and salary sometimes are interchangeably used, but it's in the end, if I get paid a lump sum number as opposed to getting paid on an hourly basis, at the end it is wages or wages that are due to an employee, and that's really basically it. And the major thing that we're just trying to make certain that you know about is how to record them, what they are, and what they look like on the financial statements, but in the end they're pretty much the same thing. So when I get my paycheck, obviously I don't get my gross pay, and I don't believe you do as well, and we get the net pay. But there are other items that are taken out of your paycheck, which we have already talked about: your federal taxes, your FICA, your state, your local medical expenses. Those costs that are taken out of your paycheck are obligations to third parties, clearly. So what happens is the organization has to accrue those liabilities and make certain they're separately stated in their financial statements, and ultimately pay those obligations on your behalf. When your federal taxes are withheld from your paycheck, when the FICA and the SUTA and all of those are withheld from your paycheck, they, meaning your employer, has to go out and write a check at some point, maybe on a semi-weekly basis, maybe on an annual basis, maybe on a monthly basis or a quarterly basis. Nevertheless, they have to accumulate those obligations, report them on their financial statements, and then at some point pay them back. And you've seen some of those entries when you're recording your entries for your project. And when you get your homework assignment, you'll probably see more in-depth explanation and recording of those type of transactions. Taxes, obviously, income taxes, employer has to pay a portion, and you have to pay a portion. And knowing how to record those transactions are important. 1/2 of those transactions are obligations that are taken out of my paycheck and yours. But the other half of it is going to be the obligations that the employer has to pay, which in case will be an expense and a liability, in which case this would be a liability being withheld. And when they meet that obligation, that liability goes away. So it's very much a portion of, well, when we record in our payroll transactions, we not only have to show that we paid employees or we owe them money, but we have to show what we withheld from them and ultimately have to pay back to the state governments, and what we are obligated to pay or match with the FICA and the suit, the FICA and unemployment, etc. We have to match and ultimately incur an expense because it is a cost of doing business. And using the W-4, again, we all know what these things are. It's just giving your organization, the employer, the obligation to withhold a certain amount of money based on the withholding that you've elected. It's all it is. FICA is going to be you're going to be your old age and your Social Security, and that's going to go into a pot, obviously, to pay you or your descendants when you are aged or if you die. Very simple. Other deductions include your savings, your life insurance, obviously health insurance, and those kinds of things. And these deductions oftentimes are going to be remitted to a third party. When it comes to your health insurance, that's going to be remitted to the health insurance carrier. Your 401k or life insurance, that's going to be remitted to the carriers of those policies. So they are going to have to withhold on your behalf, but still are obligated to pay for you because they withheld it from your paycheck. And so what we want to know is, how do we compute our net pay? Well, obviously we're going to take our gross pay and we're going to subtract all of the mandatory deductions, including taxes, and then we're going to take out the voluntary deductions, and then the difference from all those deductions and your gross pay is going to be your net pay, your net, what goes into your paycheck, or what they get remitted to you in the form of a direct deposit. You all know this because we are all working individuals and we know how it all works. But now we're putting it together in a sense of using accounting and how it looks from the accounting perspective. So you already have a basic understanding of what's happening. Let's just see how we can make this real to us and see the accounting effects of it to make it more useful information in how companies, and even if you're not going to become an accountant or use your accounting knowledge that you gain here, it is still a good idea to understand really what's happening, particularly as it relates to payroll and what goes on. It makes you more informed as an employee, and if you one day become an owner of a business, it makes you more have a better understanding and can do things correctly as an employer and what your obligations are to state governments and federal government. So again, your payroll is your paycheck. This is how you get paid. You are to tell your employees how often they're paid. Sometimes you're paid on a weekly basis. Sometimes you're paid on a biweekly. Sometimes you're paid once a month. And again, you know this at the time you're hiring. You may even know it even before then. The most important thing for internal controls is to make certain that people who have custody of the asset, meaning people who can approve individuals working for the organization, are different from the people who actually process the payroll and who actually make the payment to the payroll. Having all those duties separated will ensure that no one is being paid more than they should, and making certain that they are properly authorized. Not only hiring of new employees, the salary that they are given, the benefits that they are given, all of that should be most certainly handled by different individuals to ensure accuracy, honesty, fairness, and compliance with law for the most part. Fringe benefits are going to be more or less a vacation pay, sick pay, maybe even holiday pay, that sort of thing. Pension, again, pension is not often given these days. Many, many years ago, pension was a big deal, and that helps people when they're retired. But pension is something like a guaranteed amount of money based on contributions, a very defined way of computing what you are going to receive based on actuarial data, your age, how long you're going to live, how much you put in a rate of interest. But today, most I would say, retirement plans are going to be defined contribution, which is like a 401k, where you put in a certain dollar amount and the company in some cases will match it based on a certain percentage, and it's fixed, meaning you can actually compute the contribution because it is clearly defined. A defined benefit, it tells you what you will expect to receive under a certain set of circumstances, but it's not clearly defining what your contribution is. It's only defining what your benefit is at the end of your tenure with that organization. Very different ways of looking at things, and it's just how people are paid when they are retired. And I would say a defined contribution plan, like a 401k, like a 403b, like a 457, is going to be more of the standard. There are also Roth plans, there are IRAs, and etc. These are more like the same thing. You put in a contribution of a defined amount, and you put that in, and it is obviously going to be for the benefit of you working into retirement, and it will pay back interest. For qualified plans, you obviously get that tax benefit, and that's the most wonderful thing in the world, because you don't get any taxes on that money that continues to grow and grow and grow until you actually retire, hopefully 20 to 30 years later. And again, this is just how it should be recorded. Again, A defined benefit plan is far more complicated and it requires actuarial calculations, very, very sophisticated, because it doesn't tell you how much you put in. It only tells you in terms of guessing your lifespan and a whole lot of other factors, how long you've been in the work organization and how and your salary and all of those formulas, which is kind of complex, what your benefit's going to be. That is never an easy calculation, and in fact it's very, very complex, and there are individuals who have a very, very particular expertise and actual understanding to be able to compute it accurately, because the organization has to determine what their obligation is to you 30 years down the road, which is not an easy thing to calculate nevertheless. But again, these are all about employees and their current and long-term obligations that they will ultimately have to pay. Post-retirement benefits are obviously going to be health insurance, tuition assistance, tax services, and legal services. And not all organizations have those post-retirement benefits, but it is important to know what they are and really what happens when they are fully funded and not fully funded, and how they look on their financial statements. This definitely is something that is covered in intermediate. This is a very complex area, very, very involved area of accounting, and I don't think anyone is expecting you to understand it. But my goal in this conversation is just to expose you to what it is, and that the accounting effects of these types of benefits that our employees ultimately receive when they retire. Again, installment notes, again, these are loans, but they are sometimes a current portion of the loan and an interest, a non-current portion. And sometimes a note will have the principal and the interest portion wrapped into it. But at the end of the day, your organization will know the difference, what would be your interest part of your installment loan and what's going to be your principal, because the interest is going to be your expense, clearly, and the principal portion is going to be a reduction in your long-term or short-term liability. So understanding how they're recorded on your financial statements is important as well. No major differences other than knowing what's the distinction between the interest portion and the principal portion, and what you actually pay out, and when you pay it out, and how it's categorized, whether it be long-term or short-term obligation. And also in contingent liabilities, again, we have some potential obligation, something we might have an obligation. It's called contingent, depending on what it happens, the likelihood of it. And if it's going to be probable or reasonably probable or remote. If it's probable, it's a liability, most likely we're going to record it. If it's reasonably possible, we'll disclose it. If it's remote, we won't say anything about it. And again, this is beyond the scope of this course, because it definitely is intermediate in nature. But understand the factors that are considered when you determine if a liability is contingent or not. And that is what I think is most important in this course. And measure the liability, the potential. If it can be estimated or if it cannot be estimated. If you cannot estimate it, you're most likely going to disclose it in your financial statements. So again, this is just what I just said. If it's going to be probable and it can be estimated, you're going to record it, you're going to disclose it. If it's going to be, if it's not, probable, if it's going to be remote, you're going to ignore it. You're not even going to say, you're not going to mention it at all. And again, when we're talking about warranties, you can kind of get an idea. Warranties are probable, and you can pretty much estimate it, because a warranty is a contract. It's your contract with the person that you're doing business with, and they're going to pay you to repair, fix, or replace something that you've purchased of substantial dollar amount. And that needs to be recorded, and it needs to be estimated. It needs to know what the terms are and what your potential obligation is. So if again it's not probable, if it's probable and you can't estimate it, you're just going to disclose it. If it's reasonably possible, you're going to disclose it, and you're going to try to estimate it and record an entry. If you have it, it's remote, you're not going to disclose it, you're not going to mention it, you're not going to do anything. You're just going to ignore it. And that's essentially what you do. If it is not to be, if it's a remote chance of it happening, you don't tell anybody about it, and you just ignore it. It's never recorded on your books. And that's kind of the most important thing about these kind of contingencies. If it's remote, ignore it. If it's probable and you have a way of estimating it to some degree, you're going to record it, you're going to disclose it, and you're going to disclose it in some kind of narrative in your financial statements. So again, when you're making decisions, there are very key ratios to use, and these ratios gives you an idea of the organization's ability to pay its current liabilities. Again, these ratios on their own are not as useful as they could be, but in light of comparing them with industry or other organizations within that are similar in size and scope, these ratios can be very helpful. It's most important to note that quick ratios should not be used on their own. They should be used along with other types of analysis to determine their usefulness for decision making. And this is just giving you an idea of how to calculate these ratios. And you're going to need to know that when you're actually doing your report, your short report, and you're going to use a ratio to actually justify or explain various transactions or various financial positions that you may have about patent approved, for example. So the current ratio, the working capital ratio, all of which are important for liquidity. And a quick ratio is a little different because it's the quick assets, which ones are very, very quick to be converted to cash, and your current liabilities. So it's a little different from your current ratio, but both are very, very important in light of how they are used with other organizations of similar size in the industry. Thank you very much for your time, and I'm hopeful that this chapter is very useful to you. I'll talk to you in the next video.